Have you ever seen a candlestick with a long upper and lower shadow and a tiny body sitting right in the middle of a trend? That's the long-legged doji. It looks uncertain, but in the hands of a smart trader, it could mean massive opportunity. In this video, we'll break down exactly what a long-legged doji is, what it tells you about the market, and how to trade it with proper risk-reward, stop-loss, entry, and exit points. Let's dive in. A long-legged doji is a type of candlestick that shows extreme indecision in the market. It has a very small or non-existent real body, long upper and lower shadows, opens and closes almost at the same level. This means the bulls pushed the price high, the bears pushed it low, and yet, at the end of the session, they settled right where they started. In short, nobody won. But this confusion is where smart traders get their edge. A long-legged doji can form anywhere on the chart, but the context is key. In an uptrend, it could signal that bulls are losing control. In a downtrend, it could mean bears are exhausted. In consolidation, it screams indecision. So don't trade it blindly. Pair it with support, resistance, or key price zones. Let's look at how to trade it properly. Here's a practical entry strategy for long-legged doji. Check if it's forming at a key level like resistance in an uptrend or support in a downtrend. Use indicators like RSI or MACD for confirmation. Wait for confirmation. Wait for the next candle. If it breaks the high of the long-legged doji, bullish breakout, prepare for long. If it breaks the low, bearish breakout, prepare for short. Long entry above the high of the doji. Short entry below the low of the doji. This confirmation helps avoid false signals. Never trade without a stop loss. Here's how to place it smartly. Bullish, trade. Place SL below the low of the long-legged doji. Bearish, trade. Place SL above the high of the doji. This protects you from whipsaws or fakeouts. Risk-reward ratio. Always aim for at least 1 to 2 or 1 to 3. For example, if your SL is 30 pips, set your TP to 60 to 90 pips. This way, even if you're wrong 50% of the time, you stay profitable. Take profit levels depend on market structure. Here are 2 smart ways. Option 1. Next support resistance. Identify the next key level that's your TP zone. Option 2. Measured move. Measure the length of the shadow or previous swing. Project that distance in direction of breakout. Use trailing stop if the trend continues. Let's take a look at a real chart example. Here's a downtrend. Price hits a key support and prints a long-legged doji. What do we see next? Next candle breaks the high, bullish entry. Stop loss below the doji low. Take profit at previous resistance. This trade gave a 1-to-3 risk-reward ratio, and you didn't chase the market. The long-legged doji might look like confusion, but for the trained eye, it's often a sign of shift. Don't trade it alone. Always look at context, use confirmation, and apply strong risk management. Want more candlestick strategies like this? Hit that subscribe button and turn on notifications. See you in the next video.